Are we ready? Okay, good afternoon, everyone. This is a meeting of the Finance and Administration Committee of the Monterey Peninsula Water Management District. It is December 4th at 2 p.m. and all members are present. I think we need a roll call?
Director Edwards,
Here.
Director Eisenhart,
Here.
Chair Anderson.
Here.
All committee members are present.
Are there any additions or corrections to the agenda? And do we have any public?
We do not have any attendees on the Zoom side.
Okay,
Do not, but I do want to point out that we have Michelle Bali, our new finance CFO and manager on. And there he is. He can reveal himself. You will get to meet him in person. We onboarded him last week on Thursday, I believe. He'll be in the office Wednesday of this week. And Suresh will be in on Friday for about 10 days to cross over. So we're entering that transition. And I think he's enormously well qualified, and we're happy to have him join us here.
Nikhil, welcome to the insanity. I mean, the party. I mean, you know.
Welcome.
Thank you very much. Thank you,
We're-
General Manager Stolt and board members. I'm really delighted to be here. And I'm looking forward to working with you all and supporting the district and its amazing team in realizing its mission. Glad to be here.
Glad to have you.
glad to have you, right.
We'll give him 6 months and he'll stop saying all the right things.
Well, I don't know. He sounds like a politician. This one does. He does. From where are you joining us, by the way?
Most recently from the city of Claremont.
Oh, there you go.
And I've been in the, I've been with different cities over the last 12 plus years. Most of them were here in the Northern California region, city and county of San Francisco, city of Berkeley, city of Rohnert Park. And I have experience with managing utility operations in these cities. So
Yeah,
it's
you'll
nice to
see
hear.
a brief bio in the board packet for next week. So
Next week. Okay.
yeah.
And can we just say, Suresh is looking extremely rested. He looks very serene. Nothing is weighing on him. I can't even, pretty much I hate your guts right now, Suresh, just so you know.
Well, directors, I had a 3-day weekend, so.
Anyway, sorry, Madam Chair.
It's okay. You said it for me. So no comments from the public. We have some action items here. The first is consider the adoption of the November 6th committee meeting minutes. Are there where are they? Oh, yeah, sorry. They're short. Any comments, corrections?
Nope. Unless you
Move.
have them.
Move approval.
I will be abstaining. I wasn't here.
Oh, okay. I was here, so second. All those in favor?
Aye.
Aye,
Abstain.
and you abstain. Okay,
I feel fancy when I abstain. Can I be fair?
you are.
I feel fancy when I
You say
abstain.
You are funny. Okay, number 2, consider adoption of resolution 2023-15. And
Yeah, this is a
Dave.
retired annuitant
Mhm.
contract issue, and Simona is on, I believe. There we go.
Yep. Hi.
there
Yeah.
she is. Hello?
Hi. So yeah, as Dave was mentioning, Suresh is going to be retiring effective January 5th. And we did do a long recruitment process, and you've met Nikhil, and he is our new CFO ASD manager. That leaves us a short period of time for Suresh to kind of train him up on everything. He's got that 12 years of experience at the district that is going to take a bit longer than the next couple weeks before his retirement date. So we are looking to hire Suresh back as a retired annuitant starting January 6th, the day after his retirement. Normally, there's a 180-day period of time that you have to wait before you hire back a retired annuitant, but we would like to waive that, and that requires a resolution for the board. So that is what we're proposing and presenting to you today.
Are there any questions on the resolution? Anybody noticed?
Is he gonna work the whole 6 months?
No, I suspect, given Nishil's background and capabilities, he'll be able to be done with Suresh very quickly, but it's nice to have the availability so that as we get into budget, which is kind of an April, May period, as we get into the water supply charge on the assessors, the treasurer's collection, which is an August timeframe, it'll be nice to have him around and available on an as needed basis. So it's mostly to be simply as needed.
Well, you sold me on that,
Yeah.
because I was about to say on some of these that's coming up, I think we need to start hiring the people come June. We know people are retiring in December. We need to start bringing those people on board.
Yeah.
So the people can start going out the door December 31st.
Well,
instead of
and
hanging
it's kind of
around.
funny, Larry, district engineer Larry Hampson was the most recent example.
Right,
And I had one of my employees go, well, you'll renew Larry, right? And I said, no, I want Larry to retire. Retire means retire. And so I agree with you.
I just feel that we just need to reverse it
Yeah.
and start hiring these people on and get them,
Get them up to speed.
Get
and
them
turn
up to
loose.
speed on December 31st.
Yep.
Good retirement, it's just a reverse, and I think we can save a little bit. I move approval.
Yeah, second.
Okay, all in favor?
Aye.
Aye.
Aye. None opposed? Adopted unanimously. So we move to the next one, which is
Yep. This is
Jonathan, similar.
same type of thing
Mhm.
for Tom Lindbergh's position. You may recall we had a meeting that due to technical issues did not happen. So we weren't able to post the position. I don't think we need to hear much about the search, but to the extent John or Simona might want to comment. We don't have a great pool of candidates right now, or we didn't. I think it closes this week. John can speak to that.
Yeah,
But
it
anyway,
closes tomorrow.
closes tomorrow. So Tom has agreed to stay on, actually much to his dislike. I think he wants to be retired and not be around, but he's agreed to help train up the new person when and if that person's hired, as well as fill in the gaps while we're waiting to get the new person on.
Thank you for that.
John Lear, do you want to introduce anything more on that?
I think that was a good summary. It's just there's a large component of the job that we're being hiring for that we need to bring this new person out and meet the landowners that they'll be servicing. And so a large component will be riding around with Tom and meeting landowners so we can do our customer service correctly. So that's kind of the most important transition.
Thank you, John. Okay, no questions?
Just one.
Uh-huh.
Hey, are we paying him like him on an hourly basis?
Yeah.
Or, okay,
So
so
he just
he-
reports.
when he report, we'll pay him. If he don't report?
Exactly. And
good.
Suresh will be the same way. So,
Okay, good.
yeah.
And I don't even know. So I mean, it's like the same as any other hourly gig. I mean, it's minimum 4 hours per shift.
Well, I can't, Suresh, maybe you can speak to that. Is there a minimum for these retired annuitant contracts?
No, there is no minimum. The only requirement is we don't exceed 990 hours a year. And so we basically kind of like have a buffer in a week on 960 hours, but there's no minimum guaranteed like a like a callback time or something like that. There's no minimum requirement.
And frankly, they are just basically reporting their hours. Their hours are set based on the most recent salary, but it's not fully loaded with benefits. So it's just like an hourly salary as opposed to, full compensation, fully loaded with.
All right, but I guess it's more of a legal question. The labor code doesn't apply to these types of.
No, it does not.
Yeah. Okay.
Okay, additional questions? We have a motion?
Well, let me just say one thing. So that sort of piggybacks on your comment, right, Alvin? So if they're doing however many hours of work, okay, fine. But even if it ends up being an hour in one day, apparently that's legit.
Right,
yeah,
Whereas
right.
for everybody else,
You're not paying them the 8 hours.
it's a minimum of 4
or-
hours.
Paying for when they come in. That sound good.
Yeah, okay, thank you. So, thank you.
And we can move them to an airless, lightless closet and
No, they get light, but it's fluorescent.
We put a window in. I move approval.
Second.
All those in favor?
Aye.
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 Unanimously, that's a hard word to say.
And the next one is
Second.
treasurer's report, and that'll be Suresh as well.
Yeah, good afternoon, directors. So this is the treasurer's report for the month of October. During the month, we wrote checks in the amount of $1.7 million. Of those, $30,000 were towards rebate checks for the conservation program. The actual treasurer's report attached exhibit 4A, B, C, and D. Treasurer's report on exhibit 4A, as you can see, we started the month with $21.6 million in the bank, and we closed the month with $21.9 million. The exchanges back and forth. Excuse me. Are listed there. We also are reporting on the Pebble Beach Reclamation Project. And then exhibits B, C, and D are basically just a check register for both the regular checks and the payroll checks and the unaudited financial statements. So if there's any questions.
Just one from me on the money market on 4A. That 1.5. Looked like you took it out and you put it back, or is it out or?
No, it's actually out from money market, put back into checking account.
Oh, okay.
But that's what we do. I mean, basically the money market is our deposit account and the checking account is basically all the checks, regular and payroll checks are coming in and out of coming out of that account, the checking account.
All right, and I heard you mention COD. So that's that 1.7?
No, COD is the very last column. That's the $1 million, started $1 million in the bank, ended up with 598.
Okay, what
Very
is
last
this?
column.
What is this last one in parentheses?
I'm
That
sorry, which
voided
one are you
check?
looking?
I'm looking at Pebble Beach, under the Pebble Beach.
Uh-huh.
1, 2, the third one down.
Kind of in the
Me-
middle of the page. Yeah.
1,070,000.
Yeah,
Oh, yeah. So the 1,070,000, basically what we do on the Pebble Beach account is we bill all of the 12 golf course accounts, and then we collect the money and then we transfer it to COD because they do the operations of the account. So the 1,070,000 is just a outgoing transfer to Carmel Area Wastewater District.
okay. Sound good.
And Suresh, I, looking, it's so funny. We look at these every month, and you start to notice stuff for the first time. It's not the particular values, but it's the way it's 4D separates out everything into the trifecta, right? The mitigation, conservation, and water supply.
Yeah.
And actually, that makes me like, how do you do that? I mean, like, for example, salaries, right? I mean, yours would be everything, or legal, or, I'm just one, well, those two popped out, but do you have, I guess, two questions. One is, when there's overlap in these three categories, how do you account? And the second question is, especially when we look at other, does it matter? Why does it matter?
No, it does matter. So for example, we have three major funds. And they all have numbers. So 35 is water supply, 26 is conservation, or is that mitigation? I don't know. And 24.
Yeah, 24 mitigation, 26 conservation, 35 is
Yeah.
the water supply.
And so every year, based on the budget and where we expect the money to go, there are percentages assigned. And so if you've got a general expenditure of the district that's just kind of an overall generalized, then it gets allocated by those percentages. If it's a singular expenditure that's obviously just for the conservation activities, then 100% of it then goes into the conservation account. And then like my percentages are different than the general percentages. I think I'm 60% to water supply, 25% to conservation.
It's 60 to water supply, 20 and 20 to mitigation and conservation.
Yeah. So something. So yeah. So everything gets broken up differently.
And what, I'm just curious, I mean, big picture, why does that matter?
Well, a couple of reasons. When we had, for example, the water supply charge, all of those revenues were targeted to just the water supply function. And so those revenues go in, and then there would then be general allocations. So like when there's an election year, your election expenses or the district's election expenses on your behalf would be broken into based on the percentages to each department or each fund. And then, a piece of it would be paid by the water supply charge in the water supply account, but couldn't be done so in the conservation or the mitigation. And so it's a way to keep track of where you can and can't use monies. And then some of our grant monies can only come into a certain area and go out for a certain purpose. So same type of thing.
I just think of it as one big happy entity, but
Yeah.
you're making it sound like we're really, in many ways, three entities.
Well, and in fact, where Nichelle comes from, they probably have, who knows, 17 or 20, because you got public works department.
A lot of it
things.
depends on the financing. If it's a payment by CalAM, that's dedicated to certain activities, conservation by way of example. If it's tax revenue or fee revenue, tax revenue we can use for anything. So we can use it for elections purposes. Fee revenue, it all has to go to water supply.
And if you think about it by extrapolation, if we were to take over to CalAM.
Yeah, that was my next question.
18 months from
Yeah.
now, we will establish an enterprise fund. But right now, the only enterprise fund that we have is the reclamation project, which is interesting because it's audited not by our auditor, but by COD's auditor, but it appears on our books. But then we will convert either the water supply fund or open a new fund, but it'll be an enterprise fund. And then within that, there's going to be other funds set up because the size of the organization will be different and bigger. And so, there's a lot of this that will just look completely different than the simplicity of where we are today.
Fascinating.
The guys next door, the wastewater, they're kind of in between a major city and us, probably, 7 major fund accounts, but everybody's a little different.
All right. Wow. That was interesting. Thank you.
Okay, any other questions?
No questions.
Okay. Motion, please.
Move to approve or adopt the October 2023 Treasurer's Report.
I'll second it.
All those in favor?
Aye.
Aye.
So these next two are annual reporting under GASB. The first one, GASB 68, related to the CalPERS pension obligation, and the second one, GASB 75, related to post-retirement benefits. And Suresh, before you start, can you just provide us an update on the schedule for the audit?
Yeah, so they are working on the audit right now. The audit will not be ready by December 31st, so we will be filing an extension with GFOA for the ECFA award. But the audit will most likely go to the January board meeting.
Okay, great. Thanks. Go ahead and cover item 5, followed by item 6.
Yeah, so item 5, basically, as Dave said, this is the pension reporting standards that was established by GASB, and that is statement number 68. We have done this every year where we've basically updated the board in terms of what the pension obligation numbers are, both for the pension side and also the OPEB side, which is next item. As I had mentioned, the standard was established by Government Accounting Standards Board, and every agency has to follow that. Every public agency has to follow that. In June 2012 is when the GASB approved this new reporting standard, statement number 68, and that was to be implemented by 2015, June of 2015 financials. And again, the statement said basically to record the net obligations, pension obligations on the financial statements. And the district has complied since 2014-15 financial statements. So every year when we present our ECFR, it is as part of the ECFR report is the pension obligation that's being reported in there. Our post-retirement, which is part of the pension, basically we have 2 tiers, a classic member, which were employees hired prior to January 1, 2013. They are on a 2% at 55 PERS formula. The PEPRA members, anybody that was hired after January 1, 2013, that was the big PEPRA reform by the state. And so now anybody that's hired by the district after January 1st, 2013, they are part of the PEPRA member formula, which is 2% at 62. Now, people that are coming to the district from prior employment as a CalPERS member, they are treated as classic members. So this is only for new employees that enter the district service and they don't have any prior PERS entry. They are coming as the PEPRA members. There's going to be some on the report itself. There's going to be some terminology, the TPL, what we mostly refer to, which is the total pension liability. And there's also some other terminologies on there, which is sometimes you'll see on the report itself, FNP, which is the fiduciary net position. And then you'll also see net pension liability, and sometimes we abbreviate that as NPL. So just wanted to throw that out there. The pension obligation, or the NPL, the net pension liability, as of June 30th, 2022, stands at little over $7 million. It is about a significant $3.5 million increase from last year's numbers. Last year, June 30th, 21, the pension numbers were $3.5 million. And about 2 years ago, ending June 30th, the pension obligation was $6 million. So these numbers do fluctuate. I just wanted to focus on this year's number, why there's such a huge difference. The discount rate did not change. It's still at 6.8% as was last year. The big change was the investment rate of return by PERS. So PERS is expected to earn somewhere between, expected to earn 6.8%. This year, as of June 30th, 2022, the investment rate of return for PERS was negative 6.1. So as you can see, that's almost like a 12.9% shift. Basically, they did not make 12%. They've lost 12% as what was expected, 6.8, but they gained minus 6.1. So that's where that net delta difference is. So that's the biggest change as to why our liability changed from $3.5 million to about a little over $7 million. The funding status, yes.
So you mentioned 22. This is 23.
He missed.
Correct. It's
Okay.
No, it's not misspoke.
No, it's always a year behind.
Yeah, but the
Always a
7
year behind.
But what you misspoke, I did hear it. The $7.088 million figure is 2023. That is the
Okay.
2020.
It's 2022.
But it says
I
2023.
heard 22, yes.
It does say,
It says 2023.
Oh, okay. So on my report itself, on my staff note, it should have said 2022. Because PERS is 1 year behind on the numbers.
So you see so I don't know if you're looking at page 1 of the
The
committee report. Yeah, it says district net pension liability as of June 30, 2023 is estimated at $7,088,000. You're saying
that number, I apologize. That should have read as of June 30th, 2022.
Oh, okay. So we're always a year behind.
we always a year behind. It's PERS is such a basically large pool of members that they are not able to do the numbers for the current year. They always do 1 year behind.
So Suresh, in the staff notes, so we get it right for the board. Can you
We'll,
pull it
we'll
up?
change. I'll change that. Yeah.
Yeah, because
Well, and
then it makes a comparison right below the table to June of 2022.
One.
And that should be 2021.
I think I
I
was
see.
doing both the GASP 75 and GASP 68 numbers together. And so basically that's where kind of like my head was. I kind of like, there was an oversight
Well, I hope,
But we'll get it fixed for the board packet.
for the board packet.
I hope your replacement is listening to this.
So but let me, just on that.
I'm listening.
Just on that, it's actually a 13-point differential between the discount. Geez, I mean, is that normal?
They have had negative returns in the past. I mean, in the last 5 years, they have not. I mean, I'll just give you a comparison in 2022. So it's negative 6.1, right? 2021, their rate of return was 21.3%. And that's why our pension obligation dropped from $6 million to about $3 million. Back in 2020, their rate of return was 4.7. And then 2019 was 6.7, 2018 was 8.6. But about 10 years ago, they did have some negative rate of return as well. So 2022 was not a good year. And so the negative rate did impact a lot of agencies, not a lot, but all of the agencies. And just to put in comparison, Director, the 3-year rate of return average is about 6%. The 5-year rate of return average is about 6.7. 10 years is about 7.7, 20 at 6.9, and 30 at 7.7. So they typically, that's one of the reasons why PERS discount rate was about 7.25% or 35%. And they dropped it from that to 7.25 to 7 to 6.8 because they did look at in comparison, they did look at the average rate of return for a 20-year average, and they pegged it that it wasn't, the 7.25 was not materializing. And so that's the reason why it dropped it to 6.8%.
But think about it. PERS is one of the largest investors in the world. And the investment managers at PERS get paid pretty well. And they're underperforming the market or performing as poorly as the market right now. And I don't know, think of your own investments or not, but there's a thing called asset allocation. And based on, current economy and what's going on, you should look at your asset allocation. And PERS, 15, 20 years ago added alternatives to the portfolio, and alternatives could include managed futures, venture capital funds, private equity, those kind of things. And so when the 2008 Great Recession began, they took a big hit in the portfolio in a lot of the alternatives. But then they started rebounding back and they had some good performance. But this kind of performance in the most recent market is a little bit of a red flag. It's just there are other investment managers who did not do this poorly. And so I always just kind of laugh going, well, shoot, what do these guys get paid again? I mean, it's a huge job to have. And they would be embarrassed to do this reporting, but it is what it is.
Are there any other questions?
My only question about both of these items, 5 and 6, is Suresh, I'm sorry, I just don't get it. What does it mean that we're, quote, receiving these?
Yeah. So that's a great question. And the action is to receive it because it's a required reporting. The GASBs basically said, let's go with 68 as a good example. You do a balance sheet and your balance sheet's got your assets and your liabilities. And they said, there's this other liability out there that you're never reporting, or you report solely in your footnotes quietly, but the unfunded pension liability especially for a lot of cities where they don't control their own revenue growth. kept expanding and expanding and expanding. They said, this is a little bit of a, the overreaction is a ticking time bomb. And so you need to better disclose it. And so they came up with, GASB 68 to kind of say, now we're going to give you a number every year. We're going to help you figure out that number, and then you will report that number. And it tells your public whether, if that liability is increasing significantly year in and year out, that you may want to look at it. Some of the other agencies take money. So we take money and we set it aside, but it's very small amount, a couple $100,000 a year. And we just put it into one of our internal funds where you still have discretion over it. Some cities have created trust funds where you can no longer claw that money back. And then some cities have done what's called sidecar financings, typically taxable municipal debt, so you can fill up a piece of that liability. But as Suresh has pointed out on numerous occasions, the amount of your liability can go up or go down from, a year to another year to another year, depending both on the assumed discount rate and investment returns, as well as your pool of people. As people retire and new people come in post PEPRA, the numbers change. And so if it doesn't significantly look like a liability that could somehow single-handedly undermine the district, because remember, this is a liability with multiple years of payout and people leaving at different times and so forth. But it's a bellwether for your future pension liability. And so it's worth reporting, but we've not taken those steps to try to fund it or set trust fund monies aside. That may be something that we will want to do. As Suresh mentioned in the treasurer's report, we've got 21 million sitting in the bank. The preference to date has been to just keep it all at the discretion of the board. But you may hit a point where, if we had 30 million, let's go segregate a piece of it and write it off, as available monies and say it's now permanently set for that pension liability or something. I mean, there are things we can do, but yeah, it's our government accounting standards board saying, you really ought to tell people. And same thing with the next one, which is even in retirement, we have obligations for, post-retirement people. So
Is there any argument, Suresh, or reason not to receive it?
No, we have to make sure the board is aware of it, the pension obligation. And so that's basically what we're doing, is just basically saying this is a report. I mean, these reports are not even prepared by the district. These are external reports. The GASB 68 is prepared by the CalPERS, and then the 75 is basically by a consultant. So this is just to throw it out there that the board understands that these are the obligation, and these numbers are basically going on our financial statements. So we basically making it aware to the board. And
Suresh's fiduciary duty is to make sure that they get on your board packet. If you, as a board, said, we're not receiving this, it's there anyway. So we showed it to you.
That's the right.
It's there anyways. It's a question of transparency to let the public know that you have received it, because this could be mailed to you and you would have received it.
Right.
Yeah.
Well, I mean, I guess the question is, when you say reporting it, so when we do our annual accounting reports, it's going to be on there as opposed to just a footnote, right?
Well, it's still a note. I mean, it doesn't.
No.
Yeah.
So basically, prior to 2012, it was basically always reported, but just as a disclosure note. So anybody that was reading the financial statements, they would have read the disclosure notes. Now it's going on the financial statement itself as a liability. So that's the difference. That's the difference between the 2012, when they made the GASB 68 statement, is they've forced all the agencies, made it mandatory to report it on your financial statement as a liability.
So it doesn't sound like we have a choice. We have to receive it.
Well,
And there's nothing much we can do,
We
Director.
could have mailed it to you and you would have received it, but really what we're doing is notifying the public that you've received it.
All right.
well, every year this comes up.
Yeah.
And you just gotta get yourself prepared, but this district, if you read your email that Dave sent out, transparency,
Yeah.
we are great at transparency.
Mhm.
And I feel better. I know other cities like retirement is a big issue with them.
Yeah,
Mhm.
You know,
huge.
the public would bring it out. What about that retirement? So we've been keeping it transparent as possible. And I hate to go through the end of the year because I know all these reports are coming, but I prefer it having them. The public hears do it, and they cannot go back and say they haven't heard about the retirement system failing or going bad or whatever.
I don't disagree. I'm not saying we should not receive it. I just don't understand why we're being asked to do something that's gonna happen, whether we wanted it to happen or not. I'm not understanding this
That's a great-
voting
Yeah,
mechanism.
yeah. But the public,
According to Suresh, we could all say, no, we don't receive it. And Suresh is telling me, that's nice. I'm still putting it on the annual report.
Yeah.
So I'm not sure why we're here on these two items, to be honest, but I'll play with it.
Yeah.
I move to receive both items 5 and 6.
I'll second it.
All those in favor?
Aye.
Aye, but just in the future, we need to know how many are on the old system and how many are on the new system.
Yep.
Because the turnover that we get,
Yeah, we're definitely shifting. You know?
was,
Yeah.
I went to our department Christmas party and we got all young faces in there now. And
Yeah.
all the old guys are
Yeah.
out.
All right, well, and not so old. It was only 55.
We had a staff meeting a month ago and we recognized somebody for 34 years of service. And one of our guys go, I wasn't even born yet.
Oh, no. Oh, man.
Right.
I just, no.
Yeah, and we're, you know,
Keep that to yourself.
skewing that direction. Yeah.
So Suresh, I don't know when you're gonna get us at our next board meeting, but I'd like to know how many on the old system, how many on the new system? That way the public know this agency is turning over.
It's
Yeah,
a
we can
pretty-
definitely get you that. That's a very simple report. We
Yeah,
can,
so,
And the reason it's relevant is as you shift more to the new, the post-PEPRA, they cover their pension obligation much dollar per dollar better than the legacy employees. So, yeah.
Yeah.
So
And
that's good.
You know, I know we voted on both items 5 and 6. I didn't mean to, I don't know, Suresh, if there was anything you wanted to say about item 6. I mean, I had read it. But,
Well, and you'll get to hear
Yeah,
it again. at the meeting.
yeah, the only difference in item 6, and I'll make it quick. The item 6, basically in 2004, GASB came out with statement 45, and that time, basically, all they said was, hey, report your current year liability only on the financial statements. They went back to the drawing board, and then in 2015, because the pension reporting 68 had come out, then they came out with GASB statement number 75 in 2015 and said, oh, by the way, now you got to report not only your current year obligation, you got to report the total obligation on the financial statements. So it's reported the same way as we do for the pension. The only difference is here, we have to hire a consultant and we have to get the report prepared, as opposed to CalPERS, where they basically charge a small nominal fee, like $800 or something, to prepare the GASB 68 report. For GASB 75, we have to pay like almost $3,000 or something to get this report updated every 2 years. But we have been in compliance with both statements, 45 and GASB 75. And similar to the pension side, we also have tier 1 and tier 2 program for the healthcare premium. That's the only reason why we provide this report, the GASB 75, is because the district provides healthcare premium to retirees. And so we have tier 1 employees, which are basically anybody with less than 15 years of service, they get $540 a month. Anybody with over 15 years, they get $1,400 in today's dollars, 2023. And that's escalated 3% each year. Then we have tier 2 employees, which again, anybody hired after July 1, 2013, they get $540 no escalation, nothing. And so all of those numbers, again, if the board wants, I can basically say how many employees are on the tier 1 and how many employees are on the tier 2 benefits. Just make that as part of my staff note. So there'll be a small table on there, just shows the tier 1 and tier 2 employees, number of employees.
Sounds like tier 2 employees would only be classic pensioners who have worked over 15 years.
Tier 1.
Tier 1.
Tier 1.
Tier
yeah.
1.
And
tier
then
2 has
two-
no, tier 2 has no length of service. It's basically if you retire from the district, you get $540. That's it. No escalation, nothing.
And then the waters get muddied a little bit because you can be a legacy pre-pension reform PERS participant, but if you join us, some of the benefits like sick leave and vacation leave got changed with just your employment date. And so you could be legacy for PERS, but
Hybrid.
tier 2, yeah, like a hybrid.
Hybrid.
Yeah. So Suresh, just eyeball both staff notes and make sure the dates line up.
Yeah, this one, the date is correct. This one, the date is correct. The numbers are as of June 30th, 2023,
Yeah.
because we pay our consultant to do the numbers. So this is a more updated numbers.
And I'll probably end up repeating this at the board meeting, but one of the interesting things is the liability for OPEB stayed roughly the same, but actually went down just a teeny little bit. So that math yielded no change, but the liability for PERS actually doubled.
Right.
And so and Paul, Bruno, and John Tilley on multiple occasions have said, well, you've got this other liability out here.
Mhm.
But it's not like, oh my gosh, we just had a new $3.5 million that we suddenly have to figure out how to pay for this next budget year than the prior budget year. It just doesn't work that way. You know, it's like a long drawn out liability, but somebody might grab onto that.
Yeah.
So,
Well, and that's really my last
Curb
question, Suresh, really. So when we see the $7.088 million figure on the liability, on the annual liability, I mean, it's not a liability that is set in stone. It's let's just say ambulatory.
but it does hurt us because of the way we pay. So Suresh, can you just describe briefly what we pay into PERS on an annual budgetary basis and how that liability?
There's an unfunded liability. That's a one-time, once a year payment that we make, and that's about 600,000 now. Every year that gets, we write a check to them, and then plus in addition to that, we make every pay period contributions, which equates to about 200,000, 250,000. So that's about, if you take into consideration the totality number that we pay to PERS is about 800,000 a year that we make contribution for.
And that does get affected by this number each year, kind of not directly, but in subsequent years, that payment, the lump sum payment will go up.
Right. So what happens?
Yeah.
Right. So what happens is if you take into account, so for 2022, PERS did not make 6.8%, right? So they basically had a 6.1% loss. So now there's an unfunded liability just for that year. So what PERS does is they take that liability, they escalate it for the first 5 years. It's 20%. They ramp up 20% each year. So that liability, let's just say the loss to our fund, our share was $1 million. So what they're going to do, they amortize it over 20-year period, that $1 million. But for the first 5 years, they ramp it up 20% each year. So first year is going to be 20%. Next year is going to be 40%. So up until the 5th year, when it makes up to 100% amortized payment over the 20-year period. So then that $1 million loss is amortized for the 20-year period. And after 20 years, then it drops off. So that's what they do. What I call it, it's like a rolling mortgage. Every year, based on the market. If the market does good, then it's the same methodology that's done. Is basically what they do is they take the gain. They don't apply to a fund for 1 year. I mean, all in 1 year. They basically amortize it over 20-year period. So then every year you have like a new 20-year rolling amortization mortgage. Then another 20 years every year. So it just keeps getting rolled over. So depending, I mean, if the market was going to be doing good for next 10 years, and if they gain about 10% each year, your unfunded liability is going to be gone. It'll be out. And that's what happened back about 20 years ago when a lot of the agencies were super funded because the market was doing great. And for the period of, 5 years or so, market did exceptionally well. A whole bunch of agencies were super funded. They were over 100% funded. But that's what everybody fails to realize, that it's a long-term goal, and every year just keeps rotating over. Whatever the market does, they have to factor into that whole unfunded bucket. And so whether it's a gain or loss, it just gets thrown into the bucket. So when our unfunded liability went from $5 million to $3.5 million, that was that gain factor of the 21% gain that they did on the rate of return. So then basically all of a sudden we had a significant drop in our unfunded liability. And now we've got that jump back up because of that loss that we got on the negative 6.8%, negative 6.1. I keep forgetting numbers. So that's what it is. I keep saying it's a rolling mortgage. Every year you're going to see the numbers change, and it could have a huge significant impact if the market does not do well. But yeah, I mean, that's not in the district's control. The only thing we can do is basically we can make the additional discretionary payment. But what we have done, instead of doing that payment, what we have done is we have created that side fund that David mentioned back about 5 years ago. We decided we were going to fund $100,000.
I remember that.
Yeah. 100,000 towards pension, 100,000 towards OPEB. And so as of June 30th, 2023, we have $1 million set aside, 500 towards pension, 500 towards OPEB. If we had done this 10 years ago, we would have had about $2 million in the bank now towards, earmarked towards this fund. So as long as the district is doing something, over a period of time, the long-term goal should be looking at this pension obligation and say, how are we going to address this if we ever have to pay this entire thing in totality? And there's never gonna be a zero unfunded liability. You could, like, for example, we could have paid the unfunded liability last year and said, okay, we're done with it. We would have had another unfunded liability loss because there's negative 6.1% in the market.
Yeah, and so last word on this subject, we can move on, is with our own money, that 21 million, we have a very conservative investment policy, but the place you play in the market is on the unfunded pension obligation, pretty much.
Yeah.
So.
Which you can't control.
Yep. The next two items, 7 and 8, are informational only, but I did want to point something out on 8. And if you look at the table, these are the Measure J related expenses.
Yeah.
So last month you authorized a blanket 600,000, but we didn't define which consultant. And we said we're going to be in this kind of gray area where we're not sure who's going to incur what. So the very top box that has 5 lines in it, I think the way we'll approach it, and Suresh and Nichelle, you may want to hear this one out. I think if we do set a contract that has a scope of services, then we will add to that authorized or approved, the contract approved amount column.
Mm-hmm.
But if we don't, and like in the case of Rutan legal services, which we'll need to add a line here, we'll just, as invoices come in, we'll add the amount of the invoice to the approved amount, as well as the expended to date, and we'll have to finesse where that's going to come from. So it's going to be a little bit different because we haven't let contracts for certain authorized amounts because we just don't know who's going to spend which dollars. But we need to bring that 600,000 of authorization somehow into this report. So it hasn't been done yet because this is a month behind the authorization, but that's where that 600,000 will show up. And
you think that'll be in before next Monday? Or
no, it'll be January. Yeah. And then I just want to take your attention to the draft board agenda. There's, come on. We do have on the closed session agenda, closed session number 1 is your chance to look at the combined results of my evaluation without me. And then once you reach a conclusion as to what you're going to move forward, we'll put the closed session item on for January. And then outgoing chair and incoming chair will lead the discussion with me in the room, kind of thing. And because for a couple of years now, we've separated compensation from evaluation, it'll be more a matter of just, how is the ship sailing rather than what's the captain worth type of thing. So we'll do that. And then the other two, somebody's got an open mic. Yeah, that need to, probably use Suresh.
No, it's mine, sorry.
Yeah. The other two were waiting, as you pointed out, and you brought up, I think when you walked in as well, Director Edwards, it's like, did we file yet? So
we've asked that question of our special counsel and told him that we needed to have an answer by the 11th. I reminded him that again today and asked for a status report, knowing we had this committee meeting. I've not heard back from him. So I'm hopeful that we're going to actually have it filed by that date. But if we don't, they'll have a date, hopefully, as to when it will be filed. We're pressing him for a final draft that we can share with you. We've seen a earlier set of drafts. We've commented on those. It's back in Rutan and Tucker's corner.
But didn't we authorize them to go ahead and file?
Yes.
Yeah. Okay.
Yes, we
So
have.
so it may not be a draft.
And that's what I want to hear.
Yeah.
Been done.
I'd like to either distribute the filed version or where we are.
Is this like pretty truncated, or do you have exhibits and?
Well, we have exhibits, yes.
Yeah, he
but-
attached the whole resolution of necessity without the exhibits to the findings. So the findings are footnoted to exhibits. He cut those off, but
the
he
resol-
put the surplusage in.
Once we mark.
Yeah.
I mean, it surprised me they didn't come after us on any of that stuff.
And then if I may, on the LAFCO,
Yeah.
Judge Wills has been on vacation, and he has the draft order that and writ that has been agreed to by the parties. We just need to see if he will sign it or alter it in some fashion, and then bring that back to you as well. Hopefully, we'll know that on the 11th as well.
Has anybody heard any ways at all from council or LAFCO or from anybody?
Yeah, well,
We've been in touch with them. They've not. They're comfortable with the writ that was proposed. So
Yeah, I
that's
think
been
it-
signed as to approve this form.
yeah, I think at first they had a little bit of pushback over reopening the record or not. But I think that they've come around to just to not reopen.
You can't. I thought that was gonna be sticky.
No, I don't. At the moment, I don't believe it is. We'll see what it is. How it comes from the
And
judge.
Cal-Am doesn't?
We have not heard anything from Cal-Am. They've been.
Yeah.
So on the 11th in closed session, you're gonna tell us what y'all wrote and what y'all proposed.
Yeah.
I don't want to get too much in it because
Yes, sir.
we ain't open, but that's what I'm waiting to hear
Yeah.
too.
Yeah, so you'll probably get a physical packet for a closed session. Then I wanted to just highlight item 3. There will be a slight caption change. It'll basically end
On the
without the
consent.
words on the consent calendar, item 3. It won't say approved in closed session. You're just going to certify or confirm the parameters on which we hired the new CFO. And then item 6 is basically what you received via email to help you with your evaluation of the general manager. We're not going to have a presentation or get into much detail on that. And then you see items 10 and 11, actually, not 10, 11, 11 and 12 are the two that we just went over. There may be additional questions from the other board members. So you may hear a lot of it again. And then the action items, 13 and 14, those have to be approved in a public meeting as a resolution. So that's why they're there. And then we'll have the calendar. In speaking to the chair and vice chair, there seems to be no controversy that Director Anderson will willingly take the nomination for chairmanship if given, and that George Riley, who's in rotation to become vice chair, is willing to take that nomination. And I believe that the outgoing chair agreed to do the nominating. So, yeah. One of the things to consider is we typically reaffirm the appointment of the board secretary and the treasurer, which we can do as part of that action. But Nichelle reminded me that for things like LAIF and others, to change the authorizing agent for the district, we may have certain things we have to do by resolution, and I'll expect Suresh and Nichelle to have that conversation. And whatever we have to do by resolution will probably show up on the January board packet rather than try to stick it in here in December.
Did that committee assignments, did they change?
They will change, and the way it works is it's at the pleasure of the chair to make those assignments, and typically we've all played well together, and so people typically have gotten things they're interested in doing. But yeah, so once we have the new chair, we'll make the request that the chair communicate with all of the directors individually about what committees you might want to be on, and then develop a committee list. And then January, the committee appointments will be made. And at the same time, the city mayor's select committee will be making new appointments for things like LAFCO and our city mayor position, our mayoral position. Prior to when Dave Potter became mayor of Carmel, it was Mayor
Pendergrass?
Pendergrass, thanks. I was about to say Peterson, which we know is wrong. And he was our appointee for, God, what, 21 years maybe?
Close to it.
Yeah.
Yeah, now they're getting to the point of they're trying to rotate.
And then Clyde in kind of suggested rotation.
Yeah, they're trying to rotate.
And I think our preference as staff has been rotation's fine, but let a guy have it for 2 years, because they're kind of coming up to speed and then they hit their stride, and then it'd be good to keep them. So I'll try to communicate that to the mayors somehow. And then the quirky way our legislation was written, the supervisory appointee has to be resident, but that doesn't happen until the next election. So it'll be Mary for the course of the year, but then they have an election in November. And then
They got one in March.
that's right. If they get 50%, then it's done.
10 or whatever.
Yeah, but they don't get seated until the end of the
Until the
year.
next year, to the following year.
And,
Just a reminder, it's either a seated mayor or a member of the board, or their chief executive officer.
yeah,
We've never had that, but it could be.
yeah.
Say that
Well,
again?
because
It's-
technically you could have a board of supervisors that does not have a member that resides within your district.
And then Director Eisenhart, question came up that maybe you have the answer for. Otherwise, we have the answer for it, but I haven't looked it up yet. But you ran to fulfill the unfulfilled remainder of SOFWA,
Mhm.
or did you run to fill an entire 4-year term?
Yeah.
Yeah,
The unexpired term.
yeah.
It's actually not even, well, it's not Safwat really, it's what's her name?
Oh, Molly,
Molly.
that's what it
This is
was.
still-
You're Molly, you're our Molly. That's
Just a
how,
sophomore.
that makes complete sense. And what it is, if somebody leaves prior to a number of days before the next election, then at the next election, the person has to run. That's what you did. And now you're fulfilling the full term. Yeah.
Yeah, so I
All
think there are 3 people for real.
Yeah, it'll be Amy,
Karen.
Karen, and you. So, all right.
Yeah.
Well, only if you want to. But we're so much fun that you couldn't resist, I thought.
I'm keeping all my options.
Yeah. And so
That's a good
that's
one.
really it.
That's a good one, because I might go.
George Santos.
So that.
Oh, jeez.
Oh,
Right,
This community be looking for a switch in the board,
Yeah.
big one.
So we can adjourn.
So
There
we
are a
can
couple
adjourn,
things
right.
that I want to let you know that are not on this agenda.
hey, this meeting is adjourned at 3:00.
Nice to meet you.
Welcome aboard there, new CFO.
Yeah. And you'll
Thank
see him-
you. Thank you very much.
You'll
I'll
see
see
him on
you
the
in the next meeting in person.
Perfect.
All right, we'll find out how much you learned.
11th.